Inflation's cooling, GDP slipped, and jobless claims spiked. Let's break it down, what it really means when the economy seems to be tapping the brakes. I'm Lex. You're watching Risk Wrangling Derivative Desperados on the Traders Workshop.
There we go.
Oh, yeah.
You look more like an urban cowboy, though, with this all black kind of shtick you got going on, Lex.
I would never be anything other than an urban cowboy. You know that, Mark, about me. There's no way I'm going to be hanging around horse shit. No chance.
Lex, if there was an actual City Slickers thing where you could drive cattle, like the movie, would you do it?
Sure. I've been on the Dude Ranch before. And it's very foofy. Trust me. Good eating on the Dude Ranch. All right. Good to see you guys. It's been a couple of weeks. So today we're going to try to tackle some of these economic numbers. That's what I'm going to call them collectively. So inflation, GDP, jobless claims. You could look at it all kinds of different ways. And what it might mean for the economy and going forward, right? And an interesting little spin from Jason on event. How do I say it? Event betting, not betting. I shouldn't say betting. Gosh, event trading, right? So the
binary event trading,
binary event trading, meaning who's going to win the 2028 election, Republican or Democrat. You can bet on that now, or you can make a stake. I think it's betting. I don't know. Is it betting or not?
Kind of is.
What do you think, Mark? It's kind of betting, I think.
Yeah, wagering, but there are legit economic reasons. I mean, I think that's the root of why they're allowed to be justified, is that people do have legitimate exposure to the potential, impacts of these things. So there is arguably a hedge on whatever jobless claims or whatever that you could need to put on. So
that's what I think is the key word, is hedge, because I think when, let's say you have like a long portfolio, you can use these things to hedge these events that you think can threaten your portfolio.
Right.
Instead of
it's a pretty abstract hedge, right? Like if you're long SPY and you're trading jobless claims contracts, like that beta or whatever correlation is fractional at best.
Yeah, that's right. Do you want to tackle this event thing first, or you want to do that at the end? What do you think, Jason?
Oh, no, let's talk about the economics first.
Let's talk about the economics.
I'm an economist. So, I like that stuff.
Do you want to give us the rundown? So I said in the opening, inflation definitely has come down, right? GDP turned negative, not so happy. And jobless claims rose this morning, right? It was a very big unexpected number. However, the market currently is screaming because of some big technology earnings that came out, which seems like, how is all the other stuff that we just talked about so not bleak, but a little bit dour, and yet the technology space is freaking rocking it? What's going on there?
So the first thing I want to point out is GDP yesterday is a little bit of a kind of like a false flag, because right before, April 2nd was Trump's Liberation Day.
Yep.
And that's when he announced his tariffs. People were rushing to get into the door and get all their imports in before the tariffs took effect, right? Mm-hmm. So imports are a net negative on GDP. It's gross domestic product, not including anything international, right? So imports were strongly, imports went up a lot. Consumption was still positive. Government spending came down, but it was still positive. Mm-hmm. Everything else was kind of similar levels to what was expected, except for imports. And that's what kind of drove that negative GDP. So I think it's possible it is a one data point kind of thing.
Yep.
But I mean, it is also possible that as tariffs take into effect, we will get an economic drawdown in earnest.
Right. So, and technically, a recession is 2 consecutive quarters of negative GDP. Is that accurate?
I think that's the technical definition.
So this counts as 1.
It does count as 1.
I mean, okay. So recession means I can't go to McDonald's, I think.
And we're already 1 month into Q2, so
yeah.
Oh, we got 2 months to turn this around.
2 months to turn it around. I don't think I'm worried about this one. It's technically, but your explanation was good. I appreciate that. The importing saga with the tariffs and Liberation Day probably had a little something to do with this, right?
I mean, looking at the numbers, it had everything to do with it.
Yeah. Okay. Well, that's fair. So we're not hitting the panic button now. Inflation falling, technically good. I think. Is it demand weakening or something else, or supply chain and supply improving?
Well, inflation falling though is a little bit more of a problem. I think headline inflation maybe because crude has been pulling back for a while now.
Yep.
But I think that inflation falling, even though it is falling into the Fed's 2%, is showing possible like deflation or deflationary forces finally coming into effect. It's not like we were doing the same policies over and over and we're just kind of seeing the data now, which is what everybody was expecting. I think now there is actually there could be an economic slowdown, something that the Fed was worried about before Trump was even in office, when they were raising their rates. So I think that this actually can kind of justify the Fed preparing to cut rates actually preparing to cut rates. I think if we get an employment number tomorrow that is poor, I think the Fed now has space to start cutting rates.
Okay. Well, what did they predict? Weren't the futures predicting a 50 basis point cut in rates this year, 2025? I can't remember if it's 50 basis points or bigger. I thought it was 50.
I think as of yesterday, probably something like that. I don't remember.
Okay.
I know June has like a 65% chance of a rate cut now.
Okay.
So.
All right. And then the other one was jobless claims today. So is that layoffs are starting and the labor market softening a little bit, kind of in data in a way?
Well, I mean, I live in Northern Virginia, like near DC, and I can tell you that there are a lot of people who lost their jobs over the past quarter.
Yeah.
So, I mean, I haven't had a chance to look in depth into those numbers yet, but I would expect to see a lot of government layoffs.
Mm-hmm.
I mean, we've been seeing hundreds of thousands of layoffs in this area of contractors and government employees. So I think that might be, there might be something to that.
Okay. So is this enough information then for either of you two? I know you guys, you have clients and what have you. Is this a strategy shift in your minds in terms of how you use options in your portfolios? Mark, you want to tackle that? It could be just a simple no. I get it, but is there something that could be advantageous for you two to look at in terms of structuring, a pretty good trade here?
I think in terms of, medium and long-term vision, I think I'm squarely in the no camp, but I think what this recent drawdown, in particular the speed of this recent drawdown, has made clients a lot more interested in buffer type strategies, right? And seeing the way buffer strategies behave, whether they're within an ETF, which, suboptimal in my personal opinion, but or whether you're executing it yourself, there are a lot of realities of puts paying out. What does that look like in terms of now you have a short-term gain? Is this an opportunity to start buying in? Where you set the buffer, just the speed at which we dropped, right? Q1, if you're on that standard kind of buffer level of 5 to 20%, that 20% is getting tested. And so that introduces, a lot of new conversations because it's hey, most of the time the market doesn't go down 20% in the quarter. Well, we felt differently at the beginning of April. So I think what this is demonstrating is how strategies that you may have been around for a while, if you've only been doing this for a couple of years, you haven't seen this type of market.
Yeah. Good points. Jason, do you have any thoughts on that part of it?
Well, again, I'm going to
techniques or
again, I'm going to call on my location of Northern Virginia, there's a lot more fear here probably than elsewhere because of, government layoffs and contracts ending. So over here, it's less of I want to be more defensive in my investments and more of what happens if I lose my job kind of thing.
Yeah, sure.
So that it's a little bit, it's kind of more of an urgent, kind of more of an urgency feel here.
Okay. So from my take too, so on the retail side that, I get a pretty good glimpse into numbers. And I know you guys look at this, the option volume data is significantly higher than normal, right? So we're seeing 70 handles and 70 million prints on days, 50, 70, 60. We had 100 million plus print about a month or so ago on one of those big down days, which has never happened before. That was a record. So my point here is that option volume is solid, right? It is solid and it is very, very active. However, we have seen from the true retail side a downtick in option volume. And I think it plays a little bit to the point that implied volatility when VIX has a 30 handle or above, it feels like true retail takes their hands and sits on them. And they say, I ain't playing in this space, because it feels like a lot of retail people who are doing it themselves tend to sell a little premium, short iron condors, short this, short that, theta harvesting, little plug for theta harvesting. And this confuses them and it swings them around like a rag doll. Further, I talked to an old colleague of Mark's and mine, who I won't mention any names, and these people are in the professional side of the business, the market making side, and their response is that their touch point with true retail is very, very much down in this environment of late, which also would indicate that retail is taking a snoozer on this one. Do you guys have any thoughts on that whole concept at all? Are you seeing anything to the like?
I think I've definitely heard the same about declining retail participation. I think, in general, whatever causes the kind of panic in the markets, I think you tend to see retail jump in pretty quickly when it happens. When VIX first gets above 30, everyone wants to short ball because it's mean reverting. And I think you see a lot of that type of activity. But honestly, at the end of the day, I think most people, professional or retail, are the risk of getting cut up in these kinds of markets is high. And especially if you're, a novice and, just dabbling into things, you get burned pretty quickly. And that's when the pullback happens. I think what would be healthy and good for the industry over the medium term is steady growth in the volume of contracts, right? The days when we're spiking to 100 million means something's hitting the fan. So I don't want to see OCC volume double and whatnot. I want to see a steady growth. And honestly, the last couple of days we've been a little low. I think 45s and 50s this week so far, which is better than last year's average, but a little more in line with organic, steady, consistent growth.
Yeah, that is absolutely accurate. And you like that. That's good for the whole complex, I think, right?
Oh, it's good for the goose gander and everyone in between. I mean, markets are tighter, more activity, dealer execution, all of those profits create a rising tide and tighter markets and more liquidity.
Right. So, I mean, again, not investment advice. I have to disclaim that. If you're sitting at the corner bar and some guy comes up to you and he says, "Hey, I'm really interested in trading options. I'm pretty good at it. I'm an intermediate plus kind of understanding capacity. I know all the spreads and yada yada. I've got a lot of money and I want to do some of this on my own in this environment." What do you tell them? I mean, generally, not specifically. Not saying go do this on generally. And the answer could be, go have another beer. No, well, you don't even open the machine. I mean, that could be the answer. I just want to hear what you guys have to say about that.
When somebody in any market environment, somebody asks me, I'm interested in learning how to trade options, I always warn them, all right, expect 2 to 3 years of losses. Don't, because you have to learn how to do it.
Right. The next thing you're going to tell me there's no Santa Claus. Great. The hell?
Yeah. I said, don't buy your yacht yet. But
It's actually interesting. This is part of the theme of my blog today, but like I think emphasizing the angle of just start small. Like
Yeah.
there are so many risk vectors that you don't understand, that there are the ways that which an options position can wiggle and bend, whether it's Greeks, whether it's tax consequences, whether it's like beta court, like the multitude of risk factors is so much greater than anyone imagines.
Right,
and like you just got to start small and see where you're getting burned and where you didn't expect.
Yeah, those are all both good points. You know, the other thing I forgot to mention when I was yapping there for a second is on the future side of the business, which to me is like trading equities in a way, because you can either buy them or sell them. I'm not talking about futures options. I'm talking about futures and stock.
Mhm.
That, however, has stayed pretty steadfast, if not increased a little bit. And you know, my thought there is that this is a buy or sell mechanism. You know, buying dips, selling tops, all that kind of stuff. So people understand that movement. And when you put, you know, convexity into the equation with options and all kinds of other crazy things with implied volatility, that's when people start getting confused when they're seeing 30 handle VIX kind of moves, right? Easy to understand futures in stock, I think.
Well, I think
it goes up or it goes down, period, right?
Yeah, I think that the large moves, I mean, we saw in Volin, the large moves that we had in early April expanded spreads quite a bit. And I think that probably retail saw these high prices, and typically retail just buys options, or there's a lot of like buy option retail people.
Mhm.
I know that like in Tradier's got a little bit of a more sophisticated option audience, I think, or option,
Sure.
retail trader.
Yep.
But you know, a lot of like, you know, people that I know kind of thing on Robinhood, they're just buying options. I don't even think you're allowed to sell options on Robinhood. So those people though are probably dialing back on their definitely dialing back on their option activity.
Yeah, that makes sense. That's a good point. Okay, let's move to this binary sort of stuff here. I think let's first talk about what it is. And before I'll let you lay it up, and let me just say a couple things. So we call it event-based contracts, for lack of a better term, something with the word event in it. And what we mean by that is some brokerages are moving into offering trading in event type things. It could be a presidential election, what the job number is going to be. I think it can move into sports sort of things as well, if I'm not mistaken, down the road. But any sort of event sort of thing that has a binary sort of outcome, right? I will tell you that we at Tradier are starting to look at this, which, you know, is a little plug for them. And just so everyone knows, it won't be an options contract in traditional options terms. It will look more like a futures contract. And the way it works is it's probably CFTC regulated, if I'm not mistaken. Is that right, what you said, Jason?
I think Mark said that, but yeah.
Oh, Mark, sorry.
I do know. Yeah, I do know it's CFTC regulated.
Okay, so that gives, when it's regulated like that, and you are a member of that organization, or you're beholden to them legally, you're able to offer this across all 50 states, unlike traditional sports betting where it is specific to certain states that allow it. So this is a big deal in terms of, in my opinion, volume and hitting certain demographics in the country. And it's also a big deal for DraftKings and FanDuel, because if it's offered with sports at brokerages, they have to figure out what their counterplay is here to be.
Yeah, I don't see any sports on here.
No, it's not there yet. I think it's only going to come though somehow, unless there's a massive law against it for now, which could be.
Yeah.
So okay, go ahead. So Mark, anything on that? Buying makes sense. Everything good? Oh, you're on mute, I think, or I can't hear you.
I can't hear him at all.
No, my back?
Back.
Yeah, these contracts are huge. I think it's a massive expansion of capacity for brokers that when Kalshi won the lawsuit that allowed them to list these politically based things, to have that money connected to your brokerage account breaks down so many barriers. And I think it's a really interesting area for expansion.
Right.
I somewhat doubt their hedging capabilities against your equities and whatnot, but the fact that same pot of money is meaningful.
Yeah, I agree with that. And my response to someone who talked to us about this in terms of listing. I said, listen, the bottom line is liquidity, right? For any retail kind of space, there has to be good liquidity. And if liquidity is there and there's activity, it should be fruitful. And I think what's the commission mechanism? It's a 2% to the, let's call it the house. Maybe that's not a great word, but to the brokerage entity. So everything doesn't add up to 100%. It adds up to about 98%, and 2% is the VIG that goes to the brokerage. Is that accurate?
Yeah, it's something like that. Yeah.
Okay.
But as far as like hedging goes, like most of these events don't have like a direct correlation. But if you're a bond trader and you can have an event thing about the federal funds rate or something like that, I mean that's a half decent hedge, right?
Sure, absolutely. Yeah. Do you want to show us on the screen?
Yeah,
Jay?
sure.
Let's
this is on IBKR.
Yeah, I know. This is great. We're at Tradier
Yeah.
showing IBKR. Well, we don't have it. We have to show something, and this is the one who has it. So, but this is what it would look like, folks.
It's like polymarket. Yeah.
So explain what's going on here. Just give us a couple examples and what can happen.
Well, tomorrow we've got unemployment numbers. So you can look here and see, the history of what people thought of unemployment numbers.
Yep.
And this is 96% of the people think that unemployment will exceed 3.8%, or at least, 96% of the people, because again, you get some juice.
Right.
But
so how do you trade this? Do you click on yes and you get to
you click on yes, and then it's like 96 cents. You determine how many contracts you want. I will be honest, I only look at this for like data purposes and kind of just interesting.
And what happens if I click on yes and buy one contract? What do I get if it's correct? If I win?
Oh, you get your dollar back in 96 cents, right?
Okay, so I get my dollar plus 96 cents.
Yeah.
Okay.
Oh no. Well, if it's yes, yeah. If it's yes.
Okay.
But if it's no, or no, oh no. Okay.
No, you pay 96 cents to get a dollar.
To win a dollar. Yes. They pay 96 cents to win a dollar.
Okay. And then you pay 3 cents to win a dollar.
Yes.
Got it.
Yeah,
okay.
For no.
So I know what I'm doing.
You're doing no.
Hell yeah.
That's a Lex special right there.
Oh
no.
my God, are you kidding me? This is gambling.
It kind of is.
Damn.
Well, it's funny, some of the more liquid markets, and Lex, I couldn't agree with you more that liquidity is really what's going to determine the viability of these, right? Like,
right.
Yeah, and difficulty of hedging some of these things, is certainly a question. But some of the efficiencies in, like the poly market, online markets, where things that are near certainties are like your cost to win is like barely the risk-free interest rate. Like it's, 96 cents to win a dollar with all that downside, and you're barely earning more than like T-bills. Like, who's buying that?
Yeah, exactly. So people are going to play the pick'em markets, right? Ish.
Mm-hmm.
It sounds like. I mean, the pick'em. What I mean by that is the 49.49 ones or thereabouts. Give or take some shekels.
Yeah. I mean,
or they're going to do what I just said and
your contract and lose your job because the employment rate's over 3.8%.
Yeah, or they're going to play the way out outliers for the chance of the little hit.
Yeah.
I mean, I'm looking at this, but there's so many things you can trade. You notice I'm using the word trade, right? Not bet.
Yeah.
I
mean, this is always. Will 2025 be the warmest year on record?
I love that one. You know what I would say though is Mark to you from our market making days. Wouldn't you love to be on the market making side of this though?
Yes and no. It really depends on the hedgeability, right? Like you don't want to be swamped by some customer that makes like a $10 million bet on no warm winter, and you're like, short snow shovels or whatever.
Yeah.
Like,
so what do you do as the market maker?
Short snow shovels.
How do you hedge it?
Exactly. Like,
right.
I mean, there are legit, like Jason made the point, right? Like if you have a bond book that's fairly complicated, if you have some correlation to interest rate movements on Fed funds rates, you're doing a lot of short-term lending like a bank, like there are needs for some of these derivatives. Insurance companies arguably could be talking about warmest weather, type stuff. Like we've seen cat bonds like listed. So like there are legitimate reasons. They're just fairly niche.
Right.
Yeah.
Right. Okay.
Yeah,
Interesting.
which makes this gambling, especially even if you're a market maker, you're still kind of gambling. But I think the market makers are the brokerages, right? Like they just collect both sides and just do the payout and get 2% no matter what, right?
Yeah.
But they don't want the exposure. Like I don't actually know if the brokerages want to take the other side. I think it's an order book like any other security.
Yeah, I think the brokerage is like where I would want to be is I want to be the toll booth. That's what I want to be in this equation, right? I want my 2%, and I just want it to be rush hour traffic all the time.
But to get that 2%, that's assuming you're taking the risk. If you're assuming you're capturing the bid-ask spread.
No, if I'm offering as a brokerage, I got something in some revenue source, right? And I think I get a piece of that 100%. So that's how they charge on these. I think
It's not a transaction fee.
I don't think so. I don't think I could be wrong. Well, I'm
pretty sure I paid a transaction fee on Robinhood when I traded.
It might be, but it might equate to 2%. So it might be the same. I mean, we might be saying the same thing.
I do believe the contract fees are relatively high percentage wise. Yeah, but I think your buyer seller. I think you're paying the spread and that contract fee.
Yeah, could be. So if people can, in the comments, if you can type in a 1 for I hate this idea event trading, or like a 3, I love it. So if you can get to that little thing, I'd like to get a little feedback on this if that's possible. So I what I say, 1 love, 3 hate. Okay,
that's a tight scale.
Or you did the other way around.
Yeah, I'm doing a 1. I think I love it.
You like this?
I do. I think I like this. I don't know.
I think if nothing else, like kind of the way I use it again is, just to see, will the Democratic Party win a majority in the United States in the 2026 general election? I like to see, what are people saying for that? Yes or no.
Right. Right.
And then obviously look at this. There's a ARB here, isn't there?
What do you mean? How so?
I mean, I could do like is there an ARB here? Because there's like if I hit yes here and yes here.
No, like if you buy both no's, you pay 102%.
But yeah, right here. If I do double no, that's 102%. That's an ARB, isn't it?
Well, you got to buy the no's though.
Yeah.
So if you have to own 2 no's, you paid 102%, and one of them is guaranteed to pay out, so you only get $1 back.
Yeah. So you lose 2%.
That's a guaranteed ARB for the other side.
Yes. Yeah. So it's a guaranteed ARB for yes. Because you're paying out 95% and you get $1 back. So it's an ARB.
On the yes side. Why is that?
Because there's not enough open interest on one side or the other. I don't know. But on the yes side, there's an ARB. Maybe it's an independent party ARB.
There you go. Oh.
Yeah, that's a pretty big percentage for the independent party, though.
Yeah.
But 2026, okay, but calculate the interest that you'd earn on, that might be it, right? Like, what is the interest that you'd earn on 95 cents? Like, you actually probably earn more than 5 cents over the next year and a half.
You get 5% over the next year? Like, what's the 1 year, rate?
Yeah, like at the 30 days at 4.3. I don't know where the 1 year is. But like, even if it's 4% for a year and a half, you're going to do better putting 95 cents in the bank than buying both yeses.
Yeah.
That's gotta be what it is.
That's a good point. All right. I like it though. I like the layup. Very good. Very good. So we don't have a big trade today, I don't think. I'm not selling premium. I'm not selling premium here. Just so we're clear.
No, you're not doing any condors or anything?
No. I'm like what I'm seeing. I'm sitting on my hands. I'm at a disadvantage trading on a screen right now. I hate to say it. So, but you got to do something sooner or later. It's coming. I know it's coming. So, how did you like the risk wrangling derivative desperados, you mothers? I just combined them all.
It's your show, man.
Combined them all into one thing, one big thing. So, all right, boys.
So I just did the arithmetic. You can lock in the 1 year right now at 3.8%. So your forward interest rate risk on 16 months assumes you can reinvest at least 1.3%. So that's your opportunity cost there. So as long as you can reinvest at more than 1.3% for the next 6 months, 1.3% annualized for the next 6 months, you are better off putting your money in cash than buying both yeses.
Well,
so that's really the implicit bet you're making on that.
Yeah,
it's really a rates bet. It's not a presidential bet.
Well, that explains why it is what it is.
Yeah, exactly. That's why it's not an ARB.
Yeah, it's not an ARB. Yeah. Interesting. All right. Well, thanks for that, Mark. You little genius.
Yeah, nerd.
You nerd. All right, you guys have a good weekend. Good to see you as always. Mark, drink some good wine. Harvestedfinancial.com. Jason, adeumfunds.com or vol.land.
Yep.
Right? Everyone knows where to find me, hub.tradier.com, or send me an email. I love emails, lex@tradier.com. And look for more great things to follow. Anything else, boys, before we go?
No? I'm good.
Mark?
Happy.
Oh, he broke up. Happy trading. He said happy trading. I know he did.
Oh, yeah. Happy trading.
All right, boys. Good night.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.